the most important thing you can, what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle.
All right, Buffett just said it. Great companies are those that have an economic moat. For one reason or another, some businesses are protected from competition. However, not every economic moat is built equally. So the question I want to discuss in today's video is which types of economic moats are the most enduring, the most sustainable, and which competitive advantages are the least sustainable and thus less valuable. And later in this video, I will actually reference 3 investing legends and show you what they think about this exact question. So without further ado, let's get started. Hello fellow intelligent investors, my name is René Salman, and as I outlined in the introduction of this video, today we will talk about economic moats. And more specifically, we will rank different economic moats in terms of their strength, depth and durability. And I guess to get started, we should first define the term economic moat. What's a moat? Well, a moat is a distinct and structural advantage a company possesses that is difficult to replicate by competitors. And thereby a moat creates a barrier that is difficult to overcome for competitors. And this inherent characteristic of a business allows this business to earn high returns on capital for a longer than average time period. And it keeps competitors from taking away both market share and profits. Now there are different types of economic moats. I would say usually investors distinguish between 4 to 5 different sources of economic moats. But some investors, like Hamilton Helmer, for example, who's the author of the wonderful book 7 Powers, identified more than 5 moats. And in one of my books and my framework, I actually identified different types of moats within each category. For example, different types of brand moats. And I highlight 23 different competitive advantages. And then there might actually be so-called hidden moats, such as specific business cultures. So that's a set of attitudes, values, beliefs, goals, and other characteristics of a company or organization. And you usually cannot find these hidden moats in standard investment textbooks. But these hidden competitive advantages might still allow businesses to achieve superior profitability. But in this video, I will stick to the traditional 4 to 5 sources of moats that investors usually discuss. And we will rank these 4 to 5 competitive advantages with regard to their strength. But before we do that, let me just give you a very brief overview of the attributes of each of these moats and maybe point out a few companies that serve as a good example. All right, so first off, a firm might possess intangible assets such as intellectual property, brand recognition, patents, or regulatory licenses. And these intangible assets might prevent competitors from copying products. Moreover, these intangible assets allow a company to charge premium prices due to either perceived higher value or reduced uncertainty. However, building brands usually takes a lot of time and basically cannot be done overnight. And thus, these intangible assets create a high barrier to entry. And a prime example of this type of moat would be Apple, Ferrari, or Rolex. Maybe you could also mention Disney here. Then, secondly, some firms benefit from scale and cost advantages. Cost advantages are often gained through economies of scale, and for companies with low fixed costs. As these businesses grow their volumes, per unit costs decline. And companies that are able to produce products or create services at a lower cost than competitors, well, they are often able to sell at the same price as competition or maybe even lower prices to undercut competition, but still earn a larger profit due to either lower margins or higher turnover rates. And typical examples here would be Costco, Netflix, or the German discount supermarket chain Aldi. Another economic advantage, networking effects, can be observed when an increase in the number of people using a product or service increases the usefulness or value of that product or service for both already existing customers or users, but also for new ones. And the most frequently cited examples here are probably Visa and MasterCard, who basically dominate the global electronic payments industry. As their credit cards are accepted at so many places, the attractiveness of owning a Visa or MasterCard increased. Visa nowadays has almost 16,000 financial institution partners. Moreover, there are 3 to 4 billion individuals who possess a Visa card, and finally millions of merchants accept Visa cards as well. Now you can imagine if a business would want to compete with Visa, it would simultaneously have to convince hundreds of millions of individuals and tens of millions of merchants to switch the payment network. And similarly, network effects can also be observed in marketplace businesses such as eBay, Amazon or Etsy, but also in many social media companies. And again, Facebook is probably the prime example here. And then one last competitive advantage is offered by switching costs. Switching costs basically occur when it's easier for a customer to stay with the product or service than it is to switch to the product or service of a competing company. Even if an alternative product or service might be objectively superior, a customer might stick with the incumbent supplier or provider, as switching away from the company would be too expensive, too inconvenient, too time consuming, or generally too troublesome. To use one B2B example here, let me reference an example that the investment firm Van Eck used in a 2021 prospectus. They wrote the following: Salesforce.com Inc. is a leader in providing cloud-based solutions that address many aspects of customer acquisition and retention. According to Morningstar, its Salesforce automation application is mission-critical software that helps drive revenue for users. Morningstar notes the high organizational risk of moving away from the platform, as well as the time, expense, and lost productivity associated with the implementation of a new application. And if I may add one B2C example here, it would be switching from Apple's ecosystem to devices from a competitor, and getting used to a new software interface. And I would argue that switching costs for Apple customers probably only grow when they own more than one device in the Apple ecosystem. And the iCloud service has certainly added yet another layer to the switching costs of Apple customers. Alright, so this was just a very brief and very basic overview of the different types of moats that I wanted to give you here before we rank the types of moats. Now, broadly speaking, the stronger a company's moat, the more money a company can earn. And the more durable a moat, the longer a firm can earn excess profits. If you can identify companies with the wide and deep moats early on, you will likely enjoy great compounding returns over the years, as those businesses earn high returns on capital, and they can do it again and again and again, and have stressed the importance of high returns on capital and the ROE metric in a previous video of mine. And I highly recommend watching it after you've finished watching this video, in case you have missed that video. A moat basically protects above average returns on capital. Now, a clever question that you could ask is, which type of economic moat is the most sustainable and thus the most valuable? Which competitive advantages can best fend off competitors? Can we rank the 4 sources of moats that I have highlighted in this video in terms of their strength? Well, before I share my thoughts here, I would love to know what you think and what your ranking would look like. So please share it in the comments down below. How would you rank the 4 to 5 moats that I have presented? So that would be brands, intangible assets, such as intellectual property or patents, network effects, switching costs, and cost or scale advantages. All right, so here's my take. Can we rank these types of moats? Well, I would say yes and no. I tend to lean towards no though. And maybe let me explain why. If we look at brand moats, for example, then clearly not every brand moat is created equally. I mentioned Apple, Ferrari and Rolex as examples in this video. And those are probably among the highest quality brands around the world. Does this mean that every brand moat is as strong as the brand moat of these three firms? And does every brand moat translate into the same level of superior and sustainable profitability? No, obviously not. The Victoria's Secret brand, for example, was known for its lingerie and fashion shows around the world with some of the most well-known supermodels. And there were millions of viewers in front of their TVs every single year. Basically, it was a prestige brand, and Victoria's Secret lingerie was considered a premium product. But over the last 6, 7 or 8 years, the brand has certainly been losing its glory a little bit. Victoria's Secret's annual same-store sales have actually fallen a few years in a row, and the stock value of the parent company L Brands also declined significantly between 2015 and 2020. Now, if you want to learn more about this development and the Victoria's Secret brand, I recommend this 10-minute documentary titled The Rise and Fall of Victoria's Secret that you can find on CNBC's YouTube channel. Now, interestingly, Victoria's Secret was actually spun off by L Brands quite recently, so you might want to take a closer look at both of these stocks and companies now. And now let me just show you a Charlie Munger and Warren Buffett clip in which they also highlight that not every brand creates the same economic value, and that not every brand is as long-lasting as, for example, Ferrari or Patek Philippe.
Yeah, there are a lot of different models that create a sustainable competitive advantage, and there are also some models of where you can lose it very fast. You just ask Arthur Andersen. That was a very good name in America not very long ago. And I think it would be harder to lose the good name of Wrigley's gum than the good name of Arthur Andersen. I think there's some perfectly remarkable competitive advantages that people have gotten over time. And the great trouble with the investment process is that they're so damned obvious that the stocks sell at very high prices.
Snickers has been the #1 candy bar for probably 30 or 40 years now.
Yeah, in Russia, it turns out everybody likes Snickers.
Yeah. How do you really knock it off? I mean, we make candy. We would love to displace Snickers, but it's hard to think of ways to knock them from the #1 spot. I mean, my guess is that they'll be #1 in 10 years from now in candy bars, and the list doesn't change much in that field because if you think about the nature of how you make that choice as to what candy bar. If you were chewing spearmint chewing gum 5 years ago and you buy a pack of some chewing gum today, it's likely to be spearmint. I mean, there's things that you experiment a lot with, and there are things that you don't fool around with once you're happy. And
okay, what Buffett is hinting at, I think, is that the industry a firm is operating in also plays a crucial role. As we all know, Buffett likes industries that change very slowly. And as we were just talking about Victoria's Secret, then obviously the fashion industry is changing very rapidly every single year. And this is something that Buffett actually also highlighted during another Berkshire meeting. And so I just want to show you one more clip here.
Yeah, to some extent, Charlie and I try and distinguish between businesses where you have to have been smart once and businesses where you have to stay smart. And I mean, retailing is a good case of a business where you have to stay smart. But, you are under attack all of the time. People are in your store. If you're doing something successful, they're in your store the next day trying to figure out what it is about your success that they can transplant and maybe add a little something on in their own situation. So you cannot coast in retailing. There are other businesses where you only have to be smart once, at least for a very long time. There was once a Southern publisher who was doing very well with his newspaper, and someone asked him the secret of his success, and he said, monopoly and nepotism. And
So what if I were forced to rank the competitive advantages that I presented in this video? Then, yeah, well, here's what my list would look like. I would argue that network effect moats are probably the hardest to overcome, followed by switching costs. However, I would add that what I don't want to see here is, switching cost companies that are basically just treating their customers like cash cows. I would then put brands in spot number 3, intangible assets such as patents in spot number 4, although intellectual property is generally speaking probably more valuable than patents, as patents are subject to expiration. And then finally I have cost advantages in spot number 5. But again, there are certainly companies with cost and scale advantages whose moat is much stronger than the network effect advantages of other companies. So please take this ranking with a grain of salt. And let me just stress one more again that this illustration is probably a massive overgeneralization. Now, the most interesting and most valuable part of this video might be what Mr. Pat Dorsey has actually said with regard to this question. If you don't know Pat Dorsey, he used to work for Morningstar, basically was part of Morningstar's team that developed the moat or economic moat ranking that you can find on Morningstar. Today, he runs his own asset management firm, Dorsey Asset Management, and I recommend pretty much every interview that you can find with him. Well, Pat Dorsey was asked which type of moat he values most highly. And let me just share you here what he responded. Interviewer: can you tell us what type of moat you prefer and which are generally more sustainable? To which Dorsey responded, I'm not sure one is better than another. I get this question a lot and I thought about it quite a bit. I would say that there are weak and strong brands. There are weak and strong switching costs. There are cost advantages that are very durable and some that are a little bit more ephemeral. I'm not sure that I would regard one type of moat as stronger than another, with the possible exception of a network effect, which you see in financial exchanges, credit card processors like Visa and MasterCard, and businesses that tend to get more powerful the more users they have. Because the way a potential competitor would need to try to articulate their economic profits is essentially by creating a similarly sized network, and that can be a very difficult thing to do. Generally speaking, if you can identify a true network effect, and it's a business that is reasonably priced, and has a lot of room for reinvestment of capital at high marginal returns on capital, you've probably found a business that's going to have high returns for some time to come. Alright guys, that's almost it. Make sure to check out some of my other videos. Make sure to leave a like and a comment. And as always, may your finances and investments prosper. Good luck.